Hello, everyone. This is Jim Barlow with OakTree Strategic Leverage. Happy to have you with us today. Um, this is a new presentation. I think I redid this, trying to get it ready 4 or 5 times. I spent more time than I wanted to, but that's how it goes sometimes. Um, we want to talk about gifting. That's the main topic. But I just couldn't help but think we need to talk about trust first. So here we go. My attorney is Christopher Finley. He's the one who I go to for estate planning and my trust and things. He did a webinar with me a while ago, and a copy of it is on this webinar is on my website. There's my website. It's under media and then partners webinar. The title is 8.5 most common estate planning mistakes. And there his phone number, his website, and email. Anyway, I thought I found some of his slides that he did that day I'd like to share with you. Not going to give you a major detail, but enough to give you a feel here. And of course, I'm not an attorney. Um, so here we go. Top client concerns. Passing estate without court involvement. Oh, yes, I like that. Avoiding unnecessary taxes, avoiding conflict amongst children. Maybe that's the most important. Avoiding financial distress due to long-term care expenses. Oh, you got to make sure long-term care is taken care of. Preserving the estate for surviving spouse. That's important. Preserving estate after remarriage of surviving spouse. Protecting loved ones, spouse, children, estate from creditors and predators. There's some issues here. Estate planning options. Spend it all. As long as you know the day you're going to die, you can spend it up to that day. 2, die intestate. And some of you are wondering, what does that mean? The next slide is mine, not his. Intestate. Not planning becomes the plan. This is when you don't have a will, when there's no document of what you want done. Then without a will, the court steps in and the state rules and determines the outcome. They have a percent that goes to the spouse, a percent goes to the children, and that money can't be spent by the spouse. And a process. It's going through probate for sure. Anyway, the law needed to have some kind of a plan for people that did not have a will. And probably is not your druthers. So don't die intestate. So what percent of Americans die without a will? I couldn't hardly believe this. 60%. Doesn't it really matter how large your estate is? Many wealthy people die without a will or a trust. So here's the rest of the options. Spend it all, die intestate, joint tenancy, usually with rights to survivorship. And that's not the end all. For one death, it appears pretty easy, but then there's still the second person. Beneficiary designations, that's the way it's required in IRAs, 401ks, things like that. So you can have a trust be the beneficiary. Then there's wills and living trusts. I'm a major fan of living trusts. I've settled the estate of my mom's that she had in a living trust. I settled the estate. I was the executor, I believe that's the term nowadays. for my brother-in-law who passed away. Very clean, very easy if the assets are in a trust. Who do you think hopes you'll never take the time to plan your estate? A little funny here. Probate attorneys, they get about a third. And they get fees. The IRS, they're getting part of it. In-laws, including that interesting son or daughter-in-law. Subsequent spouses. You really need to plan your estate. What are your options? You can go to the internet, find some document. You can buy some computer software. You can buy some self-help books. You could go to an attorney trust mill. Some investment advisors actually do trust for their clients and have the attorney behind them doing the work, but they get paid. Not the way I like to do it. Or go to an attorney who focuses on estate planning. Yes, there's an expense. I think is well worth it. And if you sit down with Chris Finley, you'll love meeting with him, getting your estate in order. Your estate is everything you own: house, cars, investments, private business, life insurance, household items, family heirlooms. When you have your estate into a trust, now you as the person can die, but your trust doesn't die. Just the manager of trust changed, and keeps moving. Very smooth. A complete estate plan is your living trust, and you got to fund it. You got to change the ownership into the trust. A pour-over will is a will that a catch-all. It's the oil pan under a car. If there's something didn't get in the trust, the pour-over will says put it in the trust. Financial power attorney. Sometimes we're just not capable of managing our affairs, so we have a document written up, a power of attorney, or we're not in the country or something, and we give financial power attorney to a friend or somebody. Healthcare documents. You can have your directive at the hospital. They know what your plans are, and you need to update these things. An old estate planning proverb. What do parachutes, fire extinguishers, and living trusts all have in common? I'm sure you have no idea. You don't know if you don't know if they'll work till it's too late to fix them. Once something's happened, it's too late to plan then. Do something before it's too late. So I wanted to talk about trust for a minute and estate planning, because before you start thinking about gifting to your kids or gifting to any entity, you need to make sure your estate plan is in order. So that comes first, then the gifting. So I wanted to handle that part on trust. Now we're going to go to gifting. We won't be talking about estate planning anymore. How do families actually gift? Here's the major major six. Annual cash gifting, 529, UGMA accounts, outright asset transfers, trust-based gifting, life insurance-based gifting. I'm going to briefly go over all of these. First, the annual gifting. The reason for talking about an annual gifting is there's an annual gift tax exclusion 2026 is 19,000. It's been creeping up. That's what the government does. So it's 19,000. What that means is you can give to a son, a daughter, or anybody 19,000 without having to file a U.S. gift tax return, Form 709. Your spouse can give 19,000. Let's say I have a daughter and son-in-law. I can give 19,000 to each of them. Barbara could give 19,000 each of them. So they can give quite a bit without filing a gift tax form. You're probably saying, I had no idea about a gift tax form. Yes, most people don't know about them. But if you go over those amounts, you're supposed to. You're giving assets right now. That you're giving money. That I get my parents. I've given money to my kids through a direct gift. My parents gave money to me through a direct gift. Annual gifting. That's the first one. Second, 529 education plans. These are set up by states. In Utah, theirs is called the My 529. You can put money into a 529 plan for a child. Let's say you put money into a 529 plan for the oldest child. You can put it for all the children, each one separately. And when you take that money and spend it on education, tuition, books, even apartments and living, as long as you document, then it's tax-free. It grew in the 529 tax-free, tax-deferred actually, and you pulled it out tax-free because you used it for education. You can change the beneficiary to different children if they're not going to college or whatever. But this is a way to gift. Give it into an education plan. Third, UGMA is Uniform Gift to Minors Act. UGMA, Uniform Transfer to Minors Act, basically the same thing. You're setting up this account called the UGMA account. You're putting assets in, and you, the parent or anybody, is managing the assets for this person. You gave it away, but you're managing it until they become of legal age. Then automatically, they're in a position to control it. Maybe you didn't change the ownership with you as the guardian custodian, but it's really theirs, and it's out of the Uniform Gift to Minors Act account when they are adult. But this is a way. I've used this. I've used all these techniques as an investment advisor. I did the number of UGMA accounts over time. Problem is, eventually they have to take charge because you permanently gave it to them. Outright asset transfer, gifting stocks, real estate, whatever. Yes, it removes assets from your estate immediately. And if it's over 19,000, you're going to have to file that gift tax form. But there's the tax issues here. The cost basis is your cost basis. So they're going to pay taxes on this asset when it's sold. But outright gifting, it's immediate. Trust-based gifting. We didn't talk a lot about trust, but you can set up a trust and have the assets for whatever purpose. You can say, this is for my children who drive red sports cars. And if you don't drive a red sports car, you don't get assets. These assets. That's a bad example. This trust is for a general fund, education fund to be used for grandchildren or whatever. But trust-based gifting, you give the assets to the trust, and the trust manages it for a certain purpose. I can tell you interesting stories about trust-based gifting. And then there's life insurance-based gifting. You buy a life insurance policy for a child, and the premium is the gift, and you're leveraging money for their future, protection, liquidity, long-term value. Kai-Zen is this, but it's not a little more structured than just buying a life insurance policy on a child. That is the major 6 ways to gift. There are other ways to gift to charities that we're not covering here today, but these are the major ways. Now I'd like to show you how Kai-Zen works in gifting. So here's the title again, Trust First, Gifting Methods Explained. What makes Kai-Zen different? I'm not going to talk a lot about inverse investing, thinking, but it's going to be part of all the webinars. But inverse investing is a discipline that starts by identifying how investors most often lose money, then making decisions designed to avoid those situations. Rather than chasing returns, it focuses on minimizing timing risk, behavioral errors, forced decisions to give you better long-term outcomes. Has there been investments that I sold to clients that I didn't quite understand the risk involved or the potential loss, thinking it was safer than I thought? Yes. Inverse thinking, a typical example is well, let's keep going. We'll kind of flesh it out a little bit. Wisdom does not begin by asking how to give more. It begins by asking where giving causes damage. We're trying to protect more than the gifting. Inversion means solving gifting backwards. It's not how generous can I be, but how do I protect outcomes for the person you're gifting to and for yourself? Most gifting failures don't come from what families plan for. They come from what they don't see, what they weren't expecting, they weren't aware of. It's the iceberg. It's all the potential things that happen underneath the water. So inverse thinking and making sure you understand the risk totally. Before I get into this, let me just, football is probably the most inverse thinking there is. 85% of the outcomes of football games is based on you not making mistakes, you not throwing the interception for a pick 6, you not making mistakes. Well, this last weekend, I could point out examples. If you're a great coach, you're first and foremost, you're working to not make mistakes. That's the main way you lose football games. So Kaizen's the structured strategy for owning cash value life insurance combines a 5-payment design, only 5 years, with a certain amount of leverage. By prioritizing downside, get my voice working, protection, tax efficiency, and disciplined structure, Kai-Zen creates a long-term growth and flexibility, protecting a lot of the downside, not relying on market timing or ongoing management. You really don't want to gamble with retirement for sure. Kaizen's good for that. But also if you're gifting, it's the way you can really benefit your family. Kairos Aurelius said, when wealth arrives before wisdom, structure must stand for a time. That's what we're doing in Kaizen. We've got a structure that's protective. Who's it designed for? Parents who care more about outcomes than just intentions. Families who value protection over convenience. Those who with meaningful incomes that want to pass on assets without harming people, who want to be generous without regret. It isn't about controlling people, it's about protecting outcomes till the wisdom catches up. There's really 3 categories of all the features of Kaizen: foundation, the growth, control. This is the 3 slides of the nitty-gritty. I'll try not to spend too long on them, but here they are. Foundation first. Removing the risk that breaks financial plans. It's based on a life insurance policy, so you have death benefit. I call it legacy, and you have living benefits. So you're protecting that family by giving them life insurance today, and you're protecting the future with giving them these living benefits. You've got disability coverage and you have long-term care coverage. Rather than having the family in your basement after a breadwinner's passing, you can have them be self-reliant because you gave them something that with legacy and living benefits. Life insurance, death benefits are tax-free. Assets in a life insurance policy grows tax deferred, and this child that you're giving this asset to can then borrow from the policy as a retirement benefit tax-free. It grows tax-free. You can use it tax-free. You eliminate the tax risk. Big deal. Our illustrations will show you a little bit in a minute. No management or advisory fees. There's no advisor. You not really need one either. There's no management of a mutual fund. So you have insurance costs, but your management fees and advisory fees is virtually zero. This is the foundation. Life insurance, living benefits, tax-free, no advisor or management fee. Hopefully that was not too fast. Growth. Participating in growth without exposing capital loss. In an index universal life policy, we can put it in market-linked growth assets with no market loss. You cannot have a negative year. Upside participation with zero downside risk. This is a big deal. Avoiding the risk of downturns. Avoiding what's the future going to be in the market, but not losing is a big deal. So this is the managing the growth. Then there's the third. There's the leverage. About 3 to 1. If you're putting in 100,000, we're going to get a bank to put in about 300,000. I did an illustration yesterday. It'll be on my LinkedIn in a while. I did an illustration on a 50-year-old hypothetical football coach making $5 million a year. And for this 50-year-old, putting $1 million in per year for 5 years, and I even put average health, not even excellent. And this was amazing. You have to look at this one anyway. Leverage 3 to 1, so that million, 5 million over 5 years. We've got, I think the bank in this illustration was putting in 17 million with, I'm not mentioning it here, but without controls, without I'll get my words in a bit. Anyway, 5-year funding. We set it up in a trust ownership, which allows the trust to do the borrowing. And it also gives some protection because it's issued out of Nevada, which has the highest creditor protection laws in the country. Very turnkey, minimal management. There's no downside. You can just leave it alone. After 15 years, that's a bit of time. Then you have liquidity and flexibility. But the growth part, the first 15 years, I can't say you have great flexibility. You've got to give this some time. Leverage 3 to 1, no collateral. That's the word I was looking for. 5-year funding, trust ownership to make sure the credit protection, turnkey, liquid down the road when you're in your retirement. That's the basic, those 3 slides is basically the features. Here's a little visual. You have 5 annual payments, or with all units, you can actually do 5 years of monthly payments. The bank is putting in approximately what you're putting in for the first 5 years. Then they're continuing with that, plus they're picking up what you were paying first 5 years. Almost a good visual on 3 to 1. And I mentioned this, but we've designed this with no credit checks, no loan document, no personal guarantees, no signature. It's no collateral. So that 50-year-old $1 million a year coach, that 17 million, there's no signature, no guarantees. You don't have to put any collateral up. It works. This is our ILIA page. This has terrific estimate my benefits on the left and a lot of things. You don't have to start here, but this is where I'm going to show you an illustration, the number crunching a little bit. I'm going to go with a 46-year-old person, excellent health, putting in 70,000 a year for 5 years. I'm going to start taking income at 65 through 90. We're going to illustrate it at 6.81. That's subject to NAIC, National Associated Insurance Commissioner regulation. And there's our tax rates we're going to use for this illustration. Why did I pick 46 and 70,000 a year? 46 is the average age of Kai-Zen investors throughout the country. 46. And the average amount they're putting in per year is 70,000. That's why I'm using this as a hypothetical. Go through the numbers pretty fast. With that 6.81%, if you did this in a regular after-tax account, you could start pulling out $58,642 starting at age 65 through 90. Here, I wanted to give this person as much income as possible out of this investment account. So I'm actually using every penny through 90. The income at 91, zero. There's no income. So you're using this after-tax investment of $70,000 a year into a regular account. And how much can I get per year? 58. Well, if you're doing an IRA or 401k, there's a little bit of alchemy there. Instead of 58, it's 74,000. And what is that? About 400,000 more income. Or we can do it in Kai-Zen, and it's about 130. It's more because no downside. The leverage and the no downside is the big deal, and no fees. So 130 total, 3,380,000, and the initial death benefit and the death benefit age 90, and this could continue to make payments. Continue the 130. I'm going to show you something. We wanted to stress test Kai-Zen to see, can it really handle this kind of stuff in bad markets? The Great Depression, 1930-32, the worst sequence of returns in U.S. history, we're showing 9 zeros out of 12 years to stress test. Would Kai-Zen work with 9 years of zeros? We didn't show the negative that the Great Depression had. People who had their money in the market in the Great Depression did not recover 100% of the money until the early 50s. So this is the worst time to invest. I'm going to show you how Kai-Zen would do in the Great Depression. And we're also going to show you how Kai-Zen would do in the 1980s, which is the high interest rate environment. Some of you remember that. I do. Loan rates got as high as 16.88. We're simulating high interest rates. Would Kai-Zen work in that era? Well, let me show you. Well, I guess my little punchline, we've stress tested against both these markets. Stress test number one, the Great Depression. Instead of 130 in a bad stock market era, it'd be 84. Well, better than the after tax of 58, better than the 74 in the IRA. And I couldn't tell you the insurance part because I didn't have it. Stress test for the 1980s, better, 97,000. So even in the worst scenarios, not bad. Oh, what's this? I said double, 260 instead of 130. Allianz said we wanted you to prove this ILIA illustration system. In fact, we want to take your illustration system and look it over. We want to see if you're being honest with your clients. And they came back and said, we think there's an 80% chance that the 130,000 will be double. 80% chance, not going to be 130, it's going to be 260. Now look at the total income. I haven't shown you the life insurance, I couldn't crunch it out. But most likely an 80% chance of 260,000, a lot better than 130, certainly better 84 or 97, 74 or 58. Kai-Zen, and even conservatively, works. Okay, this has been an illustration on way up at the top, a 46-year-old male, excellent health. Well, if it was a 46-year-old female, notice the 130 became 133. Women get a little better rating. and you can get a tad more money. Now I did something else. Instead of excellent health for this male, I gave him average health. Instead of 130, we're at 120. For average health, it still works quite well. Kai-Zen is available for excellent health or average health. If you're rated or not average, lower than average, you probably can't even buy it. They do require average or excellent health. But the numbers are, well, if you qualify, even at with average, it's not bad performance. So here's some of the tools. We have a landing page about Kai-Zen. You don't have to give me your phone number or email address. That QR code will land you at this landing page. There's chapters, there's videos. It's comprehensive in teaching you on your own, if you want, Kai-Zen. I'm also here to help. This is the first place to start. There's the QR code. Hopefully it'll give you enough time to take a picture of it. We have another landing page. This is Kai-Zen for gifting. And the other one was not. This one here is what we've been talking about, gifting. And there's a QR code for this landing page. This is a separate landing page. And here it'll teach you Kai-Zen for gifting, how it works. There's a picture of one of the videos on the front. These are really stellar landing pages. I don't know if you're using them. It's not like I'm going to notice that you're on one, but they're there for you. Eventually, if you go ahead and push the button to want to go more, you'll be asking for permission to use this website, the one that crunches those numbers. My website has a lot of links, a lot of things to help you. I have a great retirement income gap calculator, a basic and advanced. It's free on my website. I'm saying there's two ways to implement Kai-Zen. How do you want to engage? One is learn at your own pace. Those landing pages I just showed you. Learn at your own pace. You're guided all the way along. But if you have questions, I'm here. I'm the advisor-backed Amazon system. But you can learn on your own pace. Or the other way, the traditional method. I don't want to bother with that. Jim, can we go to lunch and you tell me about this thing? Tell me how it works and crunch some numbers personally? Sure. So you can do the online approach with me, asking any questions, or happy to sit down with you and help you decide if it's for you. Either one. Oh, it's this obviously the same strategy, just a different strategy for engagement. Here is my webinar series that I'm building out. So we have the basic one, the first one, Inversion, Thinking, and Kai-Zen. We'll be doing that again. I'll show you in a minute next week. Then we have the retirement version. Then we have the family gifting, which you've heard today. Then we're going to do employee retention ones, business succession, ones reviewing leverage, market volatility, taxes. I'm going to do all these on a regular basis. Here is the ones for February. February 3rd at noon, there'll be the flagship. The second one is going to be the retirement one. Then we're going to redo the family one that we're doing here. I might change a few slides between now and then. Then the February 26th, we're going to do the employee retention. How employers can use this to retain their employees or attract better ones or whatever. Anyway, there's your webinars. Kairos Aurelius, he said, what endures is not what promises the most, but endures is what fails the least. Inversion thinking. There it is in Latin. There it is in Arabic. And that's a copy of the first Inversion Thinking and Kai-Zen. You don't even have to attend the webinar. I'm posting them all on my website. That webinar is there, and the retirement income's there. This one here will probably be there tomorrow. I think I can get it done on my website. There's my phone number. There's my email. There's that link to the Kaizen. I mean to the QR code to the Kaizen site, and there's my website. I hope you've enjoyed learning a little bit about gifting and how you can use it with Kaizen. And 12:41, a little longer than I like. I prefer to have this at a half hour. I'll have to work at that. But have a good day, and talk to you next time. Bye.